industry, and we are going to see in detail how leverage buyout works and which are the main pros and cons of such a transaction. First of all, we wanted to show you briefly what we are going to see in depth, as I mentioned. And in the first part of the presentation, I'm going to present you what are the financial issues that are related to leverage buyouts in general and private equity. And later on, we are going to see which are the empirical results and the rewarding of such transaction over time. This chart is very useful to understand what is going on behind the leverage buyout and behind the entire industry. As we saw yesterday, actually, during the lecture, there is a private fund which collects money from limited partners, which can be whoever you can imagine. Obviously, it has to have lots of money in order to invest in a private fund. And then the fund creates a new firm, which actually is called a private equity firm, which asks for debt in the capital market in order to buy or to merge certain target companies according to some strategic requirements that the fund has. So let's see in depth using the balance sheet how a leverage buyout works. Of course, there is a target firm which is the target you want to hit actually. And on the left-hand side, we have, in this example, 10,000 of just hard asset. And by hard asset, we mean something that can give us a constant or pretty much constant gain over time, of course. And on the left-hand side, on the right-hand side, for simplicity, we have only equity. So let's see briefly how is the wealth of such firm. If we assume a constant EBIT of 1.5 thousand euro and we subtract the taxes, we just get 1,000 net income. So if we want to compute the ROE of such a firm, we are simply going to get the 10%. So for a shareholder investing in this firm means that he is going to get 10% for his investment. And then here we have a new firm created by the fund, which its balance sheet looks like that. In the left-hand side, we have just the money that they collected, both from their own money and from their affiliates. While on the right-hand side, we have the part from which comes from the name leverage buyout. As you can see, the 70% of the targetability of the liabilities are actually that they collected from the capital market, while the rest of the liabilities are just equity. And we, for simplicity, computed the main indexes that shows this high level of indebtedness. The leverage index, which is the most used one, which is simply computed by dividing the asset by the equity, is over 3, while the debt over equity is even 2 over 30. In our example, we assume that the NewCo merges with the target firm. So the transaction happens, and this is the new balance sheet of the firm. As you can see, we are considering a merger case, and the left-hand side of our new firm is just the hard asset that we have in the target firm. While the right-hand side is the right-hand side of the new firm that we created as a fund. Of course, we still have the high leverage, but different from before, we have the hard asset that generates the constant flow of money. Of course, this is an example. In real life, it's slightly different, but that's the flavor of how it works. So let's go into again about evaluating the EBIT. Now we also have the debt that we assume to have on average 8% of cost of interest. So we subtract both the interest and the taxes and we get the net income. Note that the net income here is lower than the one we had before in the target firm. But actually the fund doesn't care because it cares only about the rewarding that this investment has for them. Indeed, the new ROE computed as before, dividing the net income by the equity is just 21%. Very much higher than the one we had before. Now, after having done this brief example, we are going to see how the global private equity market transaction evolved starting from 1985 till 2007, when the paper has been developed. As you can see very easily, both in number and the value of transaction, this market has been growing very, very quickly. Indeed, we are surging more or less from 2001. Maybe, of course, after the crisis, we expect more or less a crash in this development, because there is no the trust that we had before in issuing the debts to the new firms. Here we divided those transactions according to the type. Of course, you can do the leverage buyout to plenty of firms, and after that you can go both public or private. You can, for example, get a new division from a still existing firm or stuff like that. The interesting thing that we are going to highlight in this chart are the transactions that get independent private, meaning that they are not public, basically. And indeed, in the 90s, they were very high with respect to the others, while they have been decreasing over time. But they still have, in general, more or less 1/3 of the entire market. While the other interesting figure is the public to private firm. So the firm that have been leveraged by out from the public and get to the private. And those from the 90s have been growing over time. Overall, we can see very easily that the market in general splits into 4 types of transactions, which are, as we saw, public to private, independent private, division, and secondary transactions. Lately, we are going to see how geographically evolved this market over time. At the very beginning, more or less 80% of the transaction occurred just in the US and Canada. But later on, the share of the market decreased. While the UK slice, let's say, of this cake has been constant over time, and Western Europe, and apart from UK, because we wanted to highlight because it was very huge, grows in this period. And now we can see that till in the mid-2007 for the data availability, the target location of the LBOs look like that.
Okay. What I'm going to discuss now are the strengths and the weaknesses of the private equity firm, and later on I want to show you the results we obtained so far. So first of all, as Jensen argued in 1989, private equity firm applies 3 types of engineering in order to create economic value and improve firm operations. Financial engineering involves providing strong incentives to the managers and the CEO of the target company through the issue of shares and stock options. But generally, they are not permitted to sell share or exercise option until the company exists, in order to avoid the possibility of manipulate the short-term performances. Governance engineering involves the control and the monitoring of the portfolio companies, and in addition to financial and governance engineering, private equity firm today applies the so-called operational engineering, which means bringing consulting and new resources to their portfolio companies, such as help with pricing, sales, productivity improvements, and acquisition opportunities. Now let's deal with the main critics of private equity firms. First of all, the incumbent management is critics often claim that the incumbent management is a possible source of inside information, and therefore private equity firm can benefit of this sort of asymmetric information. But this story empirically may not be fulfilled for at least 2 reasons. The first one is that many leverage buyout operations have failed in the past by the rejection of the board, because of the rejection of the board. And then that frequently the private equity firm brings in new management inside the firm. Actually, one firm of the board is replaced in the first 100 days. Then private equity firms are criticized for the issue of destroying jobs. The best empirical results shows that in the US, after a buyout, the employment growth is 3% lower than other companies in the same sector. In the UK, wages increase slowly compared to the market benchmark, but interestingly, in France, there is a sort of employment growth. In conclusion, these results are not consistent with the theory of job destruction, but they somehow explain that the private equity firm is able to operate more efficiently. Critics often claim that private equity firm use the benefit of tax avoidance, which means that basically they can deduct the interest that they pay on debt. And they also benefit in period when the cost of debt is relatively low compared to the cost of equity, which is called market mispricing. Okay, here this graph shows the cyclical evolution of the buyout market in a new perspective. In the y-axis there is the ratio between the median Standard & Poor's EBITDA over the interest rate paid on high-yield bonds. Generally, for a private equity boom to occur, is for company earnings to exceed the interest rate paid on high-yield bonds. This pattern held true in the late 80s, then there is a rebound in the mid-90s, and there is another peak in 2005 and 2006. Okay, talking about the results that we obtained so far, first of all, the returns to investors have been very good. Generally, the private equity fund outperforms the market, which means that on average, for each dollar invested in a private equity fund, it delivered at least 20% more than a dollar invested in for example, in the Standard & Poor's 500 index, which is a benchmark for the public market. The company performance have been also very good. The leverage buyout operations have led to productivity improvement and greater cash flows in the past. One of the main empirical results that we want to underline is the relation between the weighted capital year return to all private equity funds with the commitments to the private equity market. As we can see, the coefficient shows a strong negative relation between those variables, which means that as more capital is committed to the asset class, subsequent returns tend to decline. Okay, we can also, before concluding, we can also throw down some speculations and expectations for the futures. The first one is that we underline the possibility of a decreasing in the level of leverage because the interest rates might raise and the company earnings can decrease. Private equity firm will be more likely to take a minority equity position rather than the entire buying of a company, and so they will be growth equity oriented. Then private equity firms might be perceived as partners by some CEOs and boards. And to conclude, the performance of the most recent leverage buyout is clearly an interesting topic for future research. Okay, this was the end.